Alix Steele, Paul Sweeney. We are live from the Build America Mutual, BAM Mutual. They are located in Lower Manhattan. We're at their offices today talking about the municipal bond market, which we like to do from time to time. For those of us that live in a high-tax state like New Jersey, for example, the triple tax-free baby equivalent yield is very, very attractive. Peter DeGroot joins us, head of Muni Research for J.P. Morgan. Hey, Peter, one of the big issues, there's a lot of talk about tax reform out there. Is there ever a discussion about addressing or eliminating or adjusting the tax efficiency of municipal bonds?
First of all, thank you very much for having me here. In terms of in the municipal bond market, naturally, there is a significant amount of discussion around the potential elimination of the federal tax exemption for interest rate income on municipal bonds, right? This, as the task for Congress, is to come up with a roughly $4.6 trillion bill for the extension of TCJA. Mm-hmm. Therefore, I guess the alarm in the market started when we received a very extensive list from the House Ways and Means Committee, which included about over 100 pay-fors mm-hmm. for potential pay-fors for that extension of TCJA. On that list were some far-flung items like the elimination of the mortgage deduction for homeowners, which pretty far-flung, right? Yep. The other, which we thought was sort of remote, is the elimination of the exemption for federal taxes on for state and local taxes mm-hmm. on your federal tax forms, right? Along with those was the elimination of the exemption for tax-exempt interest for state and local bonds, as well as the elimination of the tax exemption, federal tax exemption for private activity bonds, mm-hmm. And a large catch-all for all municipals. So naturally, the market has concern. Historically, when this has come up, and it has come up regularly in pay-fors for different administrations' priorities, these have gotten washed out of later drafts of the bill. And naturally, this isn't in a draft of the bill, right? This was merely a laundry list of potential pay-fors for the extension of TCJA.
But either way, you guys had to be gaming it out a little bit, right? So, what would happen to issuance if the tax exemption part went away?
So our view is if the tax exemption went away, mm-hmm. it would only be on a prospective basis. So as we've seen in the 1986 Tax Act, and by the way, as recently as 2017, when TCJA eliminated the tax exemption on tax-exempt advance refunding of tax-exempt debt. Recall in that bill, initially they had the elimination of all private activity bonds, right? Private activity bonds account for about 25% of the municipal bond market, which might also be in play in terms of discussion this time around. But in our view, what we'll likely see is just, potentially like we saw in 2017, a little nipping at the heels of mm-hmm. the exemption. So let's say a marginalization of the exemption for municipals going forward, potentially on some sectors like higher education or potentially in healthcare, or possibly within some portion of the private activity bond space. So our view is you see lesser, or potentially, lesser tax-exempt issuance on a go-forward basis. Again, has nothing to do with bonds that are already issued and already held by investors in the market, importantly, right?
Distinction. Mm-hmm.
And that ultimately it drives scarcity value in the securities that are currently outstanding in the market. Mm-hmm. Folks buy muni bonds for two reasons: safety, surety of capital, right? Get your money back. And then two, tax-exempt interest income. We're about the only game in town for tax-exempt interest income. Supply-demand. Supply goes down. Demand remains the same. Prices go up.
Interesting. So one of those drivers you were mentioning was the tax-exempt interest. Is the expectation in your market that this will remain a vibrant market going forward? Because, again, there are some concerns there. Are you seeing any municipalities rush to get into the market, maybe sensing that maybe this exemption may be at risk?
That's an excellent point. Heretofore, we have not seen that. You might anticipate that just in terms of gaming out the probabilities here, even if you expect wholesale limitation or larger limitation on the tax exemption going forward to be sort of marginal. You would likely, out of prudence, potentially want to get some of that issuance in, pull it forward before the actual legislation is passed, right? Last year, we certainly think we saw some additional issuance as a pull forward before the election. It would make sense now as these sort of milestones are being hit or some of the concerns on the market are being hit, right? We know that tax exemption is on the list now, or at least under consideration. So it might be prudent for some issuers to pull their issuance needs forward to take advantage of the tax exemption while it still exists.
Okay, interesting. I'm curious. We were talking earlier with a guest about the natural disasters and the role that the muni market can play in that. What kind of questions are you getting from your clients about, say, the wildfires in LA?
Well, first of all, that it's a tremendous human tragedy. It's hard to run into somebody in California from the state that doesn't at least know someone who's been impacted. So, in terms of the questions that we're getting is naturally from a credit perspective, what might be impacted in the space? So sort of two sides, right? One is that historically, when we've looked at sort of these natural disasters in retrospect, there is very little long-lasting impact from a sustained credit impact on the area after the rebuild. Now, that's historically. Certainly, these LA fires are on a scale that we haven't seen before, right? Most recent estimates insured losses of $30 billion, almost 3x the largest fire that we've seen in California from an insured loss perspective. So today, for example, we saw rating agencies put on notice several credits within the space, including the city of LA, and basically a large number of utilities that do service the area with potential liability depending upon how the causes of the fire are determined over longer periods of time. Right. So, having said that, there has been very little, very few defaults in the market. Right. Limited defaults in the market.
Peter, thank you so much for joining us. Really appreciate it. Peter DeGroot, he's head of municipal research at J.P. Morgan, joining us on site here at BAM Mutual in Lower Manhattan as we talk about the municipal bond market here, a large market. But again, there are some issues out there.